Hey,
Hi.
hey, do you have any predictions to where earnings will lean this season as we are getting the banks in?
Well, I look at Goldman and I think that, again, this is a sign of tightening economic conditions. And also the other component here is a rise in expenses. And I think the expense element is something that can surprise to the upside and obviously eat into earnings. So I do think that it's going to be a little bit of contraction on earnings. I don't think it's going to be cataclysmic, but I do think it is going to take this short-term rally by surprise the deeper that we go into earnings season.
Garrett, besides one shoulder bodysuits, what trends are you looking for into 2023?
What trends am I looking for into 2023? I mean, primarily it is really built around the concept of earnings compression. I think that's the one major component here. How are companies going to respond with their forecasts looking out to 2023? There's a great divide in terms of what expectations are for the strength of this economy. Some people are predicting a significant recession. Some people are saying we're going to avoid it. I think that is going to be a major element to earnings season, largely because it's going to pull people in a lot of different directions. Looking at the dogs of the Dow, looking at the companies that were on the weaker end, the bottom end of the S&P 500, I would anticipate more challenges ahead for the big companies in the S&P 500, the Apples, the Microsofts, Meta, and I would look for reversals and strength in the bottom names in the S&P 500, those bottom 15 to 20 companies on that index.
So, Garrett, you hit the nail on the forehead when you said forecast. It's going to be interesting how companies are going to mitigate their forecast with a recession looming, if we're in
Mhm.
it or not in it. I mean, when is this going to hit, and how bad is it going to be?
All right, so I'm going to take a little bit of a different approach to really understanding what drives this economy and how this economy operates. So, a huge influx in spending has come from government, right? So, you had the Inflation Reduction Act, that capital is going to be allocated to the economy. Then you had this omnibus bill, which is 7% of GDP, huge amount of money. So, government spending, which comprises 25 to 30% of the U.S. economy, that's going to remain strong. And if that's strong, remember, it's just a math equation in terms of consumer spending, government spending, imports minus exports. This and business investment. Forgive me, in the GDP measurement. If government spending's strong, it can prevent a recession. But the problem is, what are consumers going to do? Are consumers going to slow down? And I just don't see how consumers can keep this aggressive spending up until you really dive into the basic economics of what's happening with the Federal Reserve. So right now you're seeing a slowdown in expectations for inflation, the rate of inflation. CPI is at 6.5%. Fed funds rate 4.25 going to 4.5. Subtract 4.5 minus 6.5. That gives you the real interest rate of the economy, minus 2%. When real interest rates are negative, consumers spend. This was the lesson of what happened when the central banks in Europe were cutting interest rates to negative in 2017, 18, 19. They were trying to force spending. The economics don't change. So when real interest rates are negative, consumers can borrow and effectively spend. And that's going to continue. The moment that we get into an environment where real interest rates turn positive and wages turn positive, that's where I think there's going to be a slowdown in this economy. And I think it's going to surprise a lot of people because there's no real true incentive to spend. You've eliminated one of the macroeconomic forces from this environment. That is where I think this slowdown can hit. I think that's the late second quarter, early third quarter. I'm expecting job losses to start to pile up at the end of the first quarter. And again, all of that macroeconomic effort of last year, raising interest rates, there's a lag, 6 months, 8 months, 9 months. You're going to start to see this economy slow down in a very profound manner. I'm not worried about this earnings season. I'm worried about what happens when we start looking at the March ending numbers.
Okay, so you're seeing, if should there be a slowdown, you're seeing it in the second, third quarter. Are you still? I know we discussed previously that we were predicting a market rebound in March. Are you still on board with that?
No, I've kind of moved my expectations out now to the third quarter. And the key reason for this, I think that we just have to see some level of correction in terms of these numbers. You can look, we're in an environment right now where the Federal Reserve is going to continue to lower its balance sheet. The banks and the private equity firms have all but admitted they don't understand how the Fed balance sheet works. And you had a full decade of the Federal Reserve increasing its balance sheet. There's a direct relationship between the performance of the S&P 500 and the size of that balance sheet, going from $1 trillion to about $8.5 trillion in 11 years. It goes the opposite way. When the Fed reduces its balance sheet, when it reduces liquidity in the market, when it reduces the capacity for leverage, it impacts stocks. So I don't see a rational reason for this market to be above 3,800 when the Fed is done dropping its balance sheet down to around $7.5 trillion. I just don't see it unless you see people once again coming in and be willing to pay more for the same earnings, where they start to stretch valuations once again. And we're still historically stretched in terms of valuations. I think that earnings compression, I think those valuation compressions have to happen, meaning that people stop paying 25 times earnings for a company, stop paying for growth when there really isn't growth here. I just don't, they're just, the market can remain irrational for a long time, but at some point, that comes. And I think we're going to get back down to around 15, 16 times earnings. If we move into a recessionary environment or it gets worse, then you're talking 12, 13, 14. And that's a really big move down. So again, the only thing that I care about and the way that I trade is momentum based. Capitals come into the market. I know exactly down to the day when momentum is going to turning negative. I can't say it's going to happen next week. I can't say it's going to happen in 2 weeks. But when it happens, I'm out. I sell all my long positions and I turn around and I go the opposite direction. We did it 7 times last year. We're going to do it again this year as the market presents those opportunities.